Good evening and welcome to Talk of the Bay, KSQD's local talk show, brought to you each and every weekday evening at this time, 5 to 6 o'clock. I'm your evening host, Rachel Ann Goodman, and a pleasure to have you joining us on this important discussion that we're going to have about homeowners insurance, specifically fire insurance. As disasters get more widespread in California, insurers are fleeing the state. The most recent State Farm, but they were preceded in the exodus by many other major insurers. And at this point, there are many people who have been canceled throughout Santa Cruz and Monterey County, many of them survivors of the CZU fires. So what's being done by the insurance commissioner, by our representatives, and by the insurance companies to ensure that we don't have just a huge crash in our housing for those living in fire-prone areas, which seem to be more and more people. So we're going to have a conversation about that. We're also going to invite your phone calls in just a moment. We do have a few questions that have already filtered in. First, I would like to welcome to Talk of the Bay our senator at the state level, John Laird. Hi, John. How are you?
Hi, Rachel, and good to see you. Good to talk to you.
Good to talk to you, too. And I know you just got off the floor of the Senate there, so thanks for making the time. And Carmen Balber is the Executive Director of Consumer Watchdog. Carmen, thank you for joining us as well. I think you're still muted, so we'll get you on board, still connecting. But thank you for making yourself available. We will be joined by Carmen in just a moment. Let's start out by describing the problem in case people aren't aware. I think most people who've been personally affected are very aware. I'm one of those people who lives in the CZU fire zone, and I think we're on our fourth cancellation. And the last time we got canceled, we were told we had to go on the FAIR plan and that our rates would triple. So that's probably a typical story for many people in rural areas. John, what are you hearing from your constituents?
Well, I'm hearing the obvious, that people are feeling scared, insecure, and financially vulnerable. There's a whole mix of things. When the CZU fire happened, there were, which you mentioned that you were involved in, there were 77,000 people evacuated in Santa Cruz County. That was in the summer of 2020. And there were numbers of them that returned to their homes after being out for anywhere from 10 days to 2 weeks and found insurance cancellations in their mailbox when they got back. I know of friends that are in the Boulder Creek area that are going bare, meaning they just don't have insurance. And when there were cancellations, people had the choices that you mentioned. In a few cases, people could find another insurance company, but in general, they would go on the FAIR plan, and the FAIR plan is a state-supported insurance plan of last resort. And so it's much less comprehensive coverage than you would get with a conventional insurance company, and it costs considerably more. And that is, in part, depends on insurance companies, just not related to them not covering people and going on, but in terms of holding it all together. So that's the problem. And the latest in our area was what you referred to. State Farm canceled 4,300 people in Santa Cruz County. The notices went out in the last 10 days or so. And, I hear from people as a longtime resident. There's somebody I know, former city employee, active in politics, who lives in the Seabright area and got canceled. Seabright area of Santa Cruz City. And I have no idea why that is considered a high fire hazard area. And when you mentioned fire hazard, I should back up, given my previous role of having CAL FIRE and state forests and my job when I was in the cabinet. Roughly 25% of Californians live in high fire hazard areas. It's euphemistically also called the urban wildland interface. But Paradise, some of the places around the Dixie Fire, in the Sierra foothills, certain places in the coastal range, certain places in the Santa Monica Mountains, certain places to the west and south of Palm Springs before you head into Orange County. And San Diego. There's lots of places that people live in high fire areas, and that is sort of the higher propensity of where the cancellations have happened in California.
And it's not a trivial thing to be told you have to triple the amount of insurance you have to pay. I think ours was going to go from something like $2,500 a year to $12,000 a year. And we luckily got on one other company, but it's going to run out, right? It canceled us almost immediately after they wrote us a policy. So we are in that kind of churn of every year not knowing if we can get insured. And we do have one of our first questions from Carrie Rowley wrote in to say what could happen if or when the California FAIR plan is overloaded with new applicants that were forced off of their current policies with no other option. What can it even accommodate the number of people you mentioned, which is 25% of homeowners in a very populous state?
Well, it now has over 300,000 policies in California. That's a phenomenal number, and it's a tribute to some of the insurance companies pulling out of the California market or canceling, as you just described for yourself. And a few things about it, because it feeds into the broader system. But to answer the caller's question, it has enough resources or would cover maybe one major catastrophic fire event. If there were multiple Paradise events, I don't think the FAIR plan, to the extent people in the region where the fires happened, could cover them. And it gets back to the reason we're having this call or this conversation is what can you do policy-wise to affect this, and the Consumer Watchdog will have strong opinions about this. But to get right into it, the insurance commissioner, and in 1988 the voters established an independent insurance commissioner in California, directly elected, and certain policies having to do with insurance regulation, which was designed to protect consumers and the ratepayers. The insurance commissioner, Ricardo Lara, directly elected, former state legislator, has proposed a framework which would be catastrophic modeling for rates that would result in rates of the insurance companies. Sort of, they stay in California and they help continue to shore up the FAIR plan, but if they're not leaving the state and writing policies, that in fact shores up the FAIR plan, because there's an alternative. Thousands of people will leave the FAIR plan and go to that. And catastrophic modeling means allowing the insurance companies to consider what they think are the risks related to climate. And I don't want to put words in the mouth, and I won't have to, of the Consumer Watchdog, but they're very concerned about that because of the rates that could go up, and they think the insurance companies in some measure are being let off the hook.
Well, let's bring in, let us bring in Carmen Balber, who is on the line, and we've got her back. So Carmen, hi, you've been listening. What are the problems with the catastrophic modeling as you see it?
Oh, well, thanks for waiting for me. I was having some technical difficulties.
No worries.
So, there's one thing that we agree with the commissioner on that the senator had said, which is that the way to shore up the FAIR plan is to get people out of it. And the way to get people out of it is to get home insurance companies back into the market. But the industry solution for that, and what they've convinced the commissioner to do, is a package of what we would consider deregulation. And those catastrophe models are a piece of the puzzle. Our big problem with these climate models is that they are notoriously inaccurate, biased, and have other problems. So we want to be able to be sure that the state insurance commissioner and the public can pull back the curtain, can look inside what is right now a black box, opaque process where an insurance company goes to a modeler and a modeler splits out a number. And that number might be rates should go up 50%, but we can't look and see what's going on with the math. So we want to be able to pull back the curtain and know how those models are using the science and using the specific characteristics of your home and what you and your community may have done to reduce the risk it burns down in a fire, to treat rates fairly if we're using these models.
I think that it was Lara who said that, over-regulating these companies will just chase them further away. But I'm curious if you agree with him that there's a certain balance between regulation, because didn't the voters pass something that said it couldn't, these companies could not raise their rates over a certain amount? That was Prop 103, I think. John Laird, you can correct me.
It's the one I was referring to in 1988.
Right.
Yeah. So, and that's the number of the proposition, but that's how the industry likes to paint it, and that's not really what it did. It made the insurance commissioner elected, so that's number one. He's accountable to us. And then it said, in order to get a rate increase, rather than just saying tomorrow your rates are going to be 25% higher, insurance companies have to open their books, justify what they want to charge, and get approval for a rate increase before it takes effect. It also says everything that goes into a rate has to be transparent. So, for example, if you want to use these climate models in California right now, they would have to be fully open for public inspection. And it allows the public, including groups like ours, and we use the process, to also challenge rate increases that might be excessive. So there's no particular cap on how much rates can go up. Companies just have to be able to justify what they're asking for. And in our mind, and certainly corporations sometimes have a different view of regulation, but in our mind, that is fair oversight to make sure consumers are paying a fair price, not, over-regulation.
And John, what's your perspective on this? There's some sweet spot. We are not in it. And Florida is an example of how they seem to have tried to regulate these companies, and they just ended up leaving anyway. Even after they'd given them a bunch of concessions, they're just looking at climate change and saying, we're out. This is too much of a flood-prone state, and we don't want to do this. How do we find that balance? I mean, obviously, everybody wants a solution, but I'm not sure the consumers and the companies are in very much alignment at this point about where that balance point ought to be.
No, they're not. And the thing about it is that the word you use, sweet spot, is the right thing. And it's hard, but it is the right thing. And for example, in an unrelated thing, it's unrelated, but it makes the same point. There's this big argument about water use by agriculture in California that municipal people are asked to conserve, but agriculture doesn't have the same incentive. And so I did a bill when I was in the assembly to require data on how much water is used agriculturally, individually, in a way that we could have a baseline for conservation. And the sweet spot in that bill was not to have every individual farmer disclose their water use at the gate, but deal with sub parts of districts or things that protected individual water use, but still got at the same thing for disclosure for the first time of what it was. And I don't know this issue down into the weeds in certain ways, but I believe that there is a certain sweet spot in the same way here. And I have had these different windows into it. I mean, unfortunately, I was the resources secretary during the Paradise Fire and really saw what happened. And then lo and behold, I show up in the Senate and I'm on the rules committee that does confirmations. And much to my amazement, there's this office I've never heard of before, which is something to the effect of the Office of Insurance Company Dissolutions. And there's somebody that when an insurance company goes belly up, they supervise the liquidation and as much of the protection of people that were harmed as they can. And there's a process for doing this. And in the discussions in that confirmation, we heard about there's at least one, there might have been two, small insurance companies that disproportionately covered homeowners in Paradise. And then they just, within a week after the fire, they were clearly belly up. They did not have the resources to be able to pay out to every consumer that had lost their house in that fire. And so, and that means that more and more you're leaving the insurance company to the big ones, to the ones that have hundreds of thousands of policies, and then you're more at the mercy of them in this process. And so it worries me because there was a similar thing when I first went to work for the county of Santa Cruz. There was an insurance crisis over medical malpractice insurance, and the medical malpractice insurers left the playing field. And there were physicians in Santa Cruz County that were going without malpractice insurance. And everybody was figuring out what to do, and they negotiated a solution called MICRA, which sort of limited certain kinds of payouts and other things, which in 1975 brought the insurance companies back in the market. But it turns out that the amount attorneys could recover was so capped, and it wasn't tied to inflation. So fast forward to this decade, and attorneys were not taking malpractice cases because they couldn't even recover their own costs. It had not inflated since 1975. And so when you negotiate these sweet spots, you have to make sure that there's sweet spots that move with time.
Right.
So that whether it's inflation or different angles of the catastrophe, people are protected going forward rather than based on the facts in a moment of time. And that's in part what makes this complex.
We are speaking with John Laird. He's a senator for a large part of our listening area. And Carmen Balber, she is the executive director of Consumer Watchdog. We have a question from a listener. How is it fair to be paying 20 to 30 years on a policy and never making a claim only to have it canceled? This is the problem for-profit insurance, with money going to the shareholders instead of paying the claims of longtime policy holders. I think that's more of a comment or a rhetorical question, but certainly the sense that it feels unfair for people who have done everything right only to just have the rug pull out from under them. And that's kind of where the anger, I think, is coming from. You play by the rules, and then suddenly the rules change on you. I wanted to give out the phone number once again if people would like to join us and make a question or comment about the insurance crisis here in California, how it's affecting you, and ask a question of your senator or the Watchdog group that Carmen represents. The number here is 831-900-5773, or you can email us on air at ksqd.org, and we'll read your question over the air. Carmen, over to you. Clearly, things are not working out for homeowners. Where is the wiggle room or the power that any of us have to shift this situation? We have a representative, right, who is supposed to be solving this. He's an elected official. You can unelect someone if they fail to do what you want them to do. But I feel like, in a way, consumers are not educated enough to know even what the perfect solution to this would be. Besides transparency, I mean, it really has to be affordability and availability, right?
Right, absolutely. And, you know, I could tell you what I think about the commissioner's plan, which unfortunately is not going to get a single Californian access to affordable, regular insurance coverage again. But I think the comment that your caller made actually is really a segue into the solution, because that is the problem that we're facing. If, as Senator Laird noted, an entire quarter of the state lives in a high-risk area, and we're leaving the decision about where Californians can live or where Californians can afford to live to the private for-profit insurance industry, then we are abandoning millions and millions of Californians who, as the caller mentioned, have paid into their premiums for decades. And usually when they move to the area, they had no idea that in 10 or 20 years, they might be in a high-risk fire zone. We can't simply abandon those homeowners, and we can't leave it to the private insurance industry to decide, they cannot be insured. So what do? The solution is moving California back into insurability. And one way we have to do that is by creating the incentives for homeowners and communities to protect their homes from fires. We're addressing climate change on a statewide level, but we know we can prevent communities from burning, or at least improve the likelihood that they don't burn by hardening our homes, by using fire-resistant materials, et cetera, and by clearing brush and defensible space around our homes. The senator mentioned Paradise, and in Paradise, 50% of homes that were built to new 2008 stronger, more protective building standards that are more protective against fires, 50% of the homes in Paradise built to those standards were still standing after the fire, and it was in the single digits for other buildings. So these steps are guaranteed to protect some homes from fires, but in order to incentivize homeowners to take those steps, they need financial assistance to do it, and they need a guarantee they'll have access to insurance at the end of the day. Because right now, you could put $50,000 into hardening your home, and your insurance company still isn't required to cover you. We think we need a mandate in the state of California, and this is something the legislature would have to do. The insurance commissioner doesn't have the power. That says if you do the right thing, just like a driver who's a good driver has the right to auto insurance, a homeowner who does the right thing, hardens their home, should be guaranteed access to home insurance.
Well, just to put it in perspective, I looked into putting hardy board on my house, $150,000 to rip off the wooden siding and put, the cement-based stuff on the outside. And I don't think any government's going to fund my house to do that as much as I'd love to have more resistant.
Rachel, let me comment on that a little. And I should also say that when I mentioned the person in Seabright area that was canceled, he said to me, and I can't remember the year, that they paid for 37 years with no claim. So it's exactly what, and I'm over 40 where I am. There was this interesting thing where when the CZU fire happened, the sheriff took me in. It was still burning over in your place in Bonnie Doon, but I went up Big Basin Highway and through Big Basin. And when we get through Big Basin, the sheriff says, I want to take you to see this thing. And we go on a road off of Highway 9, and we go up a driveway, and this whole neighborhood is burnt. And up the driveway is this house that is fully standing. And we parked and walked around. It was a Mediterranean-style house. And there was a short hill behind it that they had cut, but they had the kind of exterior, and I don't know what it's called, plastering and windows. And except for one broken window, and I keep asking him if he's gone back there and found out they had smoke damage. Except for one broken window, that house was standing as the fire burnt through. But as was just said, the real problem is, and Senator Becker has a bill this year, Senate Bill 1060, which will give homeowners benefit for hardening. And that is what that home did up past Big Basin is harden it. But it costs money. And unless there's some kind of financial way to incent people that are not of their own resources to do it, it creates two tiers, just those that can afford to harden that get a break and those that can't. And when the fire burned up the Big Basin Highway, the people that lived up there were this incredible mix. there were old-time mountain people that had owned their house for 25 or 30 or 40 years that were probably sort of hanging by a thread economically. And there were the commuters to Silicon Valley that had much more access to resources. And you can imagine that if there was a benefit for home hardening, those with the access to resources could have afforded it. Those that had bought their house 25 or 30 years ago and were not particularly wealthy probably couldn't, unless there's some kind of financial assistance. And I keep hearing the average of $50,000 to do some of those things. You just mentioned in Bonnie Doon what it would be for you. And that is, it doesn't even pay itself back in the lesser insurance rates unless you're paying $12,000 a year for the FAIR plan.
Right. So it really does some pretty big numbers. And I don't want to put words in people's minds, but I know I've heard articulated a point of view that says these people should not have bought in these places and they shouldn't be living there because it's just too dangerous anymore in climate.
Well, let me speak to that for a second, because the whole world has changed under us. And I don't think, I represent Big Sur, and they had a fire, I don't know, 6-7 years ago in January. The fire chief in Big Sur lost her house in a January fire in Big Sur. And when I first came back to the legislature, people there wanted me to talk to insurance agents because they were all getting canceled across Big Sur. And so I did. And the insurance agents talked about all the stuff we've been talking about on the broadcast already, but they said there were two other things, which is underlying fire protection locally and the status of the road system and the ability to get resources to the area. And in Big Sur, both those things were not optimal. And we're seeing it now. 50 miles of Big Sur is cut off from the rest of the world, and there's still 3 slides in the southern part of Big Sur that have closed off San Luis Obispo County for 14 months. And so if you're thinking about insuring there, the insurance people do a ranking based on the level of fire protection and the access to fire protection, which I don't think is totally unfair. But there still has to be a balance in this somewhere where people can get in the door. And that is the challenge. And I might differ slightly from the consumer watchdog, not in the being public and not being confidential about this information, but with the climate having changed, there is more risk. And the question is can we limit the risk in ways that it's affordable and the companies stay here?
This is a lingering question. And John, I think you said you had to be underway somewhere at 5:30, so I want to be respectful of your time. Is that still true?
Yes.
Okay. I guess that we'll thank you very much for being here with us and tackling this. I'm sure we'll be talking about it again because it's going to take quite a Herculean effort to solve. But I'm glad you are on it and listening.
And let me just say in closing that, the legislature was rumored to be doing things at the end of the last session, and it wasn't necessarily good because it's not good to do things quickly, and it's not good to do them out of the sunlight of people knowing. And I think there's a place for the legislature in this, not just the insurance commissioner and the administration. And yet I think there's a level of fear about all the different repercussions. And I'm to the point that I don't know if I can look people in the eye any longer if we are not taking some kind of action. And I have raised it at the Democratic caucus in the Senate. And I will hope that we can get somewhere on it. I hope we can provide the pressure that sort of makes the balance work here and gets people relief. And I'm hearing from many constituents, and I will continue to do that. So thanks for having me. I'm sorry that I have to go.
Thank you for being here. Really appreciate it. That's Senator John Laird, our representative for a good part of the district here in Santa Cruz and Monterey counties, talking about legislative fixes. I'm still joined for another 15 minutes with Carmen Balber. She is the executive director of Consumer Watchdog. I see that we have another possible question that came in. So let's see. Mike Kubo writes in, there are Recover California grants for home hardening, up to $50,000 for owner-occupied wildfire mitigation retrofit funds are defensible spaces and home hardening needs. There are income requirements, and maximum income level for a family of 4 is $132K. Please see hcd.ca.gov/grants and funding recover CA. And thank you so much for Mike for writing in. Mike, I don't know if you're with an agency, but I appreciate the information. High fire danger areas, much of the Upper West Side are considered high fire areas, as is Watsonville and homes north of Highway 1 from 17. So thank you for saying that. Many places you wouldn't think are actually designated high fire danger are, and probably more to come. So if you think you may be exempt from this conversation because you live in town, think again. We're all going to be in the same boat here and need to figure it out together. So thank you. Carmen, I know you have to go in about 10 minutes, so I wanted to ask you another question about Florida as kind of a bad example of giving in to the insurance company's demands because they wanted to keep them in the state, but then they left anyway. Can you talk about that story? Because it seemed a little bit of a cautionary tale about if you give them everything they want, they still leave you in the dust. Is that true?
I think you said it perfectly. I mean, what Florida shows us is we don't want to Florida-ize California's insurance market. The deal that the senator was talking about being negotiated at the very last minute at the end of session last year ultimately didn't go through, in part because my organization fortuitously caught on tape an insurance lobbyist or a guy who used to work for the industry bragging about pushing through a last-minute bailout at the end of session. And when we gave that to the media, it caused a real stir. But unfortunately, the deal that didn't get through the legislature is largely what Insurance Commissioner Lara announced he would do last September. He has said that he is going to use his regulatory power to do most of what the industry wants. And what the industry wants is what they did in Florida and has failed to stabilize the market. They want these black box catastrophe models like we discussed. We don't object to a public model, for example, that would be built by UC academics and fully transparent, or even private models that they actually let you look behind the curtain. But if they're secret, our rates are going to be unjustifiably too high. So the industry wants that. They tried that in Florida. They want to be able to pass on the cost of unregulated reinsurance, which they can't do in California, but do in Florida, and has meant rates are 40-50% higher just because of the reinsurance costs.
Could we just let me pause you for a second? A lot of people don't know what reinsurance, and I didn't know till I looked it up. But could you explain why this doubles the cost of these insurance companies?
Reinsurance is basically insurance for insurance companies. They offload the cost of the riskiest policies to another reinsurance company to take on that load. And it serves a function, but unfortunately the reinsurance industry is global and completely unregulated. And so because those costs are essentially driven by Wall Street and global financial markets and can go up at the drop of a dime because of a hurricane in Thailand, we have no control over those prices, and there's no check on what these companies can charge. And so that's what the reinsurance costs are, but insurers want to be able to pass them through in California as well. And they want to roll back those insurance oversight rules that the voters put in place under Proposition 103 that has made sure the rates are transparent and as fair as possible in California, although certainly folks are seeing extreme rate hikes right about now. And so all of those things have been tried in California. They deregulated, they use models, they pass through reinsurance, and they even charge consumers for the cost of any losses in their insurer of last resort, their version of the FAIR plan. And still, rates there are 2.5 times higher. Insurance companies are fleeing the state. And while our FAIR plan has about 4% of the market, their insurer of last resort has almost 20% of the market.
Wow.
And so giving the industry everything they want has not stabilized the market in California or in Florida. It's not going to do so here in California. What the insurance commissioner supposedly extracted for promising all of those concessions was a promise from the industry that they would move back into fire areas. But we have yet to see the details of that plan. And when we look at the text of the legislation that was circulating last year, that is really a false promise. Insurance companies would have been able, under that deal that the commissioner's plan is mirrored on, insurance companies would have been able to sell FAIR plan-like policies, not real comprehensive affordable home insurance, but FAIR plan policies that only cover, as you know, if you've had to consider one, smoke damage and fire damage and a few additional things. All of the other stuff that insurance policy is supposed to cover, theft, a tree falling on your roof, et cetera, you have to buy an extra policy on top of that. So if that is the only consumer benefit that homeowners get from giving insurance companies all of the deregulation they're demanding, then we're really getting the bum side of the deal, which is why we think we need to hold the insurance companies to account and make them cover Californians who are doing the right thing. And, not just because we think it's good public policy to protect people who have invested so much of their life into a home and premiums to their insurance company, but also because that reduces all of our risk. And that keeps California insurable.
I'm speaking with Carmen Balber. She is Executive Director of Consumer Watchdog, a group that does just that, looks out for the interests of consumers. And for those of you who are big fans of Ralph Nader, you should know that we have the Ralph Nader Show every week here on this station talking about consumer affairs as well as the economic update. So we have a couple of programs that look at these very issues, and I'm sure they're going to be talking about this one among a lot of stories. It's a really pretty big deal because the fact that we are the biggest state population-wise, and so 25% of homeowners is a giant number. I don't know how big it is, but it's quite large, and if they can't get insurance, that means you can't really sell your house, right? Because one of the requirements of a lender is that you have insurance on the property you're about to buy. So I think that's a pretty big deal that we haven't really talked about, is the unsellability of your property if indeed you cannot get it insured. So maybe people will have cash, I don't know, but that's a pretty unusual situation, wouldn't you say?
Absolutely. And that is one of the, ancillary problems that really becomes at the heart of this insurance crisis. If the insurance industry decides, a quarter of the state is 10 million Californians. If the insurance industry gets to decide that 10 million Californians are not insurable, the lost property value, this is people's largest investment, usually, is astronomical. And that has just ripple effects throughout the economy. People can't sell their homes. People can't buy their homes. People might not be able to stay in their homes if they have a mortgage, but the mortgage requires an insurance policy. They can't afford the insurance policy, so they get foreclosed on. It is a vicious cycle, and it really destabilizes a lot. Can't afford the insurance.
We have Gary on line one. Gary, you have a question for Carmen or for myself, or a comment?
I do have a comment, yes.
Go ahead.
And
yeah.
The name is Barry, not Gary.
Oh, sorry.
Yes. I live in the Santa Cruz Mountains and have a home there. Been living there for over 20 years. And we were paying about $832 for fire insurance and liability. It has now gone up to $4,100 a year. that was tacked on to our mortgage. So we just got a big mortgage payment. Also, we can't get earthquake insurance.
Right, that's been gone for quite a long time, and if you do buy it, it's not really worth it for most people because of the deductible being so high. So did you have a question for Carmen, or just a comment?
I just wanted to make a comment and just add that not only are the insurance companies fleeing California, but the insurance companies are making homeowners and renters flee the state. The people are moving out of the state because they just can't afford to live here. And I think it's just, if I may add just real quickly, I think it's just part of a bigger picture that middle class can no longer afford rentals or homes because just like PG&E, they're unregulated thanks to Gavin Newsom. The PUC just gave them a rate hike of I think it's $38 a month on top of a previous rate hike they just got. So the people that are supposed to serve our interests are not. They're on the side of the corporations. Thank you very much for taking my call.
Thank you, Barry, for sharing your story. I really appreciate it. If you'd like to join us here on Talk of the Bay, you're welcome to do so. I'm Rachel Ann Goodman, and I'm here with Carmen Balber, the Executive Director of Consumer Watchdog. We're talking about California's insurance crisis and how to get out of it, as many of the major insurers are fleeing the state, leaving people with few options that do not cost an arm and a leg, as you just heard. Barry had a doubling almost of his insurance and can't get earthquake insurance. So we're trying to figure out, what is a way out that doesn't completely give away the store, but acknowledges that these companies, the smaller ones, as John Laird mentioned, they also have to stay in business in order to serve us. So I was talking to he was a broker who was trying to help me when we got canceled one of the last times. And he was going on about how, this keeping rates down is part of the problem. But, he seemed to be on the side of the companies that we needed to let them make at least some profit so they didn't go out of business. I think he was talking about the smaller companies, not State Farm and Farmers and the big ones. What's your thought on his perspective as a broker, Carmen?
Well, the brokers are in a really hard position, right? Because they're the ones who are trying to help people like your recent caller figure out how to get insurance at an affordable price. Some of them are making dozens or even hundreds of calls to try and place home insurance, and that's a really hard job. But they are also getting an earful from the insurance companies who are telling them what they want the brokers to tell their customers about what the problem is. And that does not always match reality, the insurance industry propaganda. I would, just before I also have to go, and my apologies for that, I would just give you one piece of data, which is that the insurance industry in California, in the home insurance line, has been more profitable over the last 20 years in California than the national average. They report numbers to a national organization. They all report these numbers, and their return on net worth, which is both the claims they pay and the premiums they take in, plus their investment income, was 8.5% in California and 6.5% nationally. So they are doing better in California, despite 2017 and 18, which were no doubt terrible fire years, doing better in California than they are nationwide. So this is just not an immediate crisis where the industry is going bankrupt if they don't pull out of the state. They are using the reality of climate change to try to leverage regulatory changes that they have been pushing for decades. And that's what we're urging regulators and lawmakers not to roll over for, not to give in.
Well, thanks for fighting on our side. I appreciate you appearing on Talk of the Bay. Carmen Balber, thank you so much for being here with us on the program. We really appreciate your time.
Great to talk to you. Enjoyed it. Thanks.
Thank you. This is Talk of the Bay, and you are welcome to join us today on the radio. We have about 15 minutes before the end of the show, and both of our guests needed to go elsewhere, but you can be the next person on the line at 831-900-5773. Have you had a similar experience to us where we got canceled 3 or 4 times? The last one, One of them was right after the CZU fire. Thankfully, September 1st was our cancellation date, 2020. And we did have damage and got to make that final claim before they dumped us. So do you have a similar experience? And what do you think the solution is? Are these companies playing hardball with us and basically, threatening to leave the state and leave us in the lurch just to come back later and make more money? Is that really what's going on? Or is it something more honest, like they really are in a bad situation? So I'm curious what you think is going on here in the great state of California. The number again, 831-900-5773. If you're shy and you don't want to talk on the radio, you can certainly email us like Mike did. And the email is onair, ONAIR, at ksqd.org. But do it soon because we are only 10 minutes out now from the end of the program. This is Talk of the Bay. We're going to take a quick break and thank some of our sponsors. I'm Rachel Ann Goodman, and you're listening to K-Squid, Community Radio for the Monterey Bay.
KSQD thanks Edible Monterey Bay Magazine for supporting this program. Edible Monterey Bay Magazine delivers a story on local food and drink across the region through its quarterly magazine and weekly newsletter. The new spring issue is now available. Readers can sign up for the weekly newsletter at ediblemontereybay.com.
We thank all of our underwriters and you, if you are a contributing listener. Thank you for supporting community radio and conversations like this. Someone asked the question, since our guests are gone, I guess you're going to have to answer it. Has there been any positive benefit for homeowners who have taken measures to buffer and harden their homes against wildfires? Are insurance companies still dropping these responsible homeowners? The caller wrote in. And I would say, at least from my personal experience, we did get an extension. They were going to cancel us, this one company, but we could prove that we'd done X, Y, and Z and cut brush away from the side of our house and done a number of other things that were on the list. And then they re-upped, but only for a year, and then they canceled again. So I would say partially yes, but not for long, because it seems like there's a trend. I would also guess that these insurance companies are copying one another. If they saw State Farm leave the state, a lot of the others maybe got together and said, why don't we all leave and then make them beg to have us come back? I hope that's not true, and I think it would probably be illegal because of the antitrust laws in our country, but you can never be so sure that these conversations don't happen at an informal level. Coming up at 6 o'clock tonight from K-Squid, From the Bookshelf celebrates the 100th anniversary of the birth of Marlon Brando. Gary Shapiro talks to Bert Kearns, the author of Marlon Brando, Hollywood Rebel. That's From the Bookshelf. Coming up tonight at 6, right after this, on K-Squid Community Radio for the Monterey Bay area. I'm Rachel Ann Goodman. We're talking about insurance. And there's been a number of articles recently about this debacle, if you can call it that. One was in the Orange County Register, not an area known for its flaming consumer advocacy or anything else that might be aimed at grassroots. But they say that the State Farm General Insurance Group is reducing exposure, that's an interesting way to put it, to the California insurance market. Just like you want to reduce your home's exposure to flames. That's my commentary, not the article. Which has been a growing trend among insurance carriers. As part of its exposure reduction efforts, State Farm has announced that it will be canceling approximately, wait for the drumbeat, 42,000 apartment insurance policies. And that's just apartments. In a March 20th, 2024 letter to California Commissioner Ricardo Lara, State Farm's Chief Executive Officer Denise Harden advised that State Farm's capital position has severely deteriorated, and we are increasingly concerned about its financial well-being. In the letter, Ms. Harden explained that between 2016 and 2023, State Farm's policyholders' surplus declined from $4.1 billion to just $1.3 billion, resulting in just 50 cents per dollar of risk exposure. This steep decline, according to Ms. Harden, was due to significant wildfire losses for several years, windstorm catastrophes in early 2023 and increasing trends in non-catastrophe water losses and liability claims. Taken together, these risk exposures have resulted in a substantial underwriting losses, contradicting somewhat of what we heard from Carmen Balber just a moment ago, which is, of all the states, California's insurance providers had made the most profit of anywhere, despite the said losses. So far the article has spent at least 2 paragraphs quoting the representatives of the insurance companies, and they're just pretty much summarizing State Farm's exit love letter to the state. It went on to express a need to increase rates more rapidly. Rate increases in California can often take up to 3 years for final approval, due in part to regulatory red tape and interveners that challenge. These interveners, I think, were on our station just a few minutes ago, that challenge and delay requested rate increases by acting as consumer watchdogs. The scurvy dogs that they are, trying to stand up for consumers. How dare they? In California, these interveners, that sounds like a bad word, may participate in the insurance rate application process, investigative hearings, and regulatory hearings. Yes, it is a public process, as voters did set this up, right, a number of years ago. As Ms. Harden points out, rapid review and approval of new rates appropriate to the circumstances, along with all other upcoming and pending State Farm's rate filings, will be critical to State Farm's survival, especially in light of the potential intervener delays. They really don't like people intervening in their profit process. But I think Ricardo Lara was sensitive to their complaints because one of his proposed fixes is to speed up the review process. The other was to create a catastrophe modeling, and Consumer Watchdog says, and they were just on the radio here if you missed it, that it's not transparent enough. We don't know how these models are created. We don't really know what kind of data is fed into them versus comes out the other end as a hard and fast number that predicts somehow the risk of your home to wildfire. So some sort of transparency is needed, according to Consumer Watchdog, in order for us to have trust and believe that what we're getting is the real risk, not some inflated risk that would make them more money. Property owners are now being forced to look to the excess and surplus lines insurance markets. That's a euphemism for the FAIR plan, which, as I mentioned at the beginning of the show, usually triples or quadruples what you're already paying for homeowners insurance. Yes, there are some alternatives to the FAIR plan, but these are dwindling as they're exiting the state. So clearly, it's back to the legislature and Lara to fix this. And as we mentioned earlier, that Ricardo Lara is an elected official. So if he doesn't solve this to people's satisfactions, they can try to find another insurance commissioner who will be more responsive to consumers. Here we have one more call, and we probably have about time for one more call. On Talk of the Bay here on Community Radio K-Squid. Love to hear from you if you have a story about losing your homeowner's insurance or maybe keeping it. That would be a nice way to end the show, hearing a success story, although most of my neighbors up in the mountains have had the other story happen to them. All right, let's see who's on the line. Okay, we'll get them back. All right. Sometimes it works and sometimes it doesn't, but we'll work on that, getting you back. All right. Thanks for your patience with the phones. It's 831-900-5773. And I see they're calling back, it looks like. So we'll see if we can get them back on the line. This is K-Squid Community Radio for the Monterey Bay area. And as was mentioned earlier, in Big Sur, there is a slide, and it is closed at Palo Colorado Canyon because the slide is at Rocky Point. And right now they are not running convoys. I think they're going to resume them tomorrow. Yes, let's see. Okay, there we go. Okay. I think we got our caller back, and we're going to include them in just a second in the conversation. I want to thank you for tuning in. And again, coming up right in about 5 minutes, we have a wonderful show coming up from Gary Shapiro, and he's going to be sharing all about Marlon Brando. I don't think there's anybody there. Let's try it. Hi, you're on Talk of the Bay. I don't think they made it through the mass of the phone lines, unfortunately. Are you there? I don't think so.
Can you hear me?
Oh, now I can. Hi. Yes.
Yeah, I wanted to comment on your show and the insurance question.
Yes, please do.
I didn't hear the entire show, but I heard quite a bit of it. And one thing that it's not being talked about enough in situations, and I say this after having great sympathy for their insurance canceled, myself being one of them, coming up in Bonnie Dip, but I think there's a general sense of denial of the extent of what we're facing, climate change, climate emergency, calling it climate change.
Caller, you're cutting in and out, unfortunately. You must be in a low reception area, but I think I got the gist of what you're saying, which, if I could just reiterate, is that we're in denial about the seriousness of the climate emergency we're facing.
Yes, that's it.
Okay. Thanks for that, and I appreciate your call.
Yeah, the other thing, you could open the door and I'll come in.
Okay. All right, sounds good. We are out of time here, though. We got to go to first person singular, and really appreciate the calls and the information shared, and we will do this again. We obviously need to talk about it more amongst ourselves and with our legislators. So remember, Gail Pellerin and Dawn Addis and John Laird, they are your reps, and they are at the state level. They're the ones who can tackle this legislatively if it's not happening adequately on the commissioner level. So we need to put the pressure on if we want change, and they're the ones that need to hear from us. And they are. Thanks to shows like this, they are hearing from lots of you. So let's keep the communication lines open. And thank you once again for listening to Talk of the Bay. I'm Rachel Ann Goodman. I'll be back again with you next week. Here's First Person Singular. Stay tuned.